Good morning. Thanks, Oliver. How are you?
I'm doing well. Right now, we're waiting for the next round of spending from the government. Question that many folks have been looking at here in the market this year has been the speed, the ascent of the 10-year yield, the ripple effects that's been causing. What do you think we should be looking for as we think about the next round of spending, the next round of fiscal impulse, and what it means for the bond market?
Well, we're waiting to see how much of the spending gets paid for, right? I mean, I think I've seen this morning in some of the news something over $2 trillion in infrastructure spending, but it looks like the Democrats may try and pay for a fair amount of that with tax increases on maybe corporates, maybe some high-end tax increases on individuals. So that exact balance about how much is going to be paid for, I think, is important, particularly for the equity market, where corporate taxes may be a bit of a headwind for the equity market.
So thinking about how so far we've responded to stimulus, the dollar stopped selling off this year. We've now got strength in the dollar. Obviously, the 10-year has been moving quite quickly this year, but it goes all the way back to August when the 10-year yield bottomed. And pre-election, pre-stimulus, we've had now a lot of expectations come to fruition. Does that mean that these types of events have been priced in, infrastructure, et cetera, or do we have more reason for these trends to keep going the more information we get about spending?
Well, I think to understand what's going on in the Treasury market, you really need to break it down to what are the drivers. First of all, the fundamentals are going to continue to put upward pressure on interest rates because, we expect growth this year to be 7% in nominal terms in 2021. So that's extraordinary level of growth. And we're going to get a bit of a sort of a base effect input, near-term impact on inflation, which is going to cause inflation to tick up. So that's going to put upward pressure on yields. But you can't underplay the impact of the Fed staying at zero despite all of this and what that's going to do for bonds. So if you look at the bond market, real 10-year yields are still negative, at minus 60 basis points or so, but 5-year yields are even much more negative, minus 170, minus 175. So what's happening is the Fed is purposely keeping rates very negative at the front end, and that's going to kind of put a tether on how much the long end can move until we get closer to the Fed telling us something about stopping their current policy.
Rob, if that's the case, how come every time Powell speaks, the long end keeps moving? And the more they double, triple, quadruple down on an average inflation targeting, we just keep going higher and higher in yield.
Well, we're going to continue to get volatility. That's key. But I think the way to think about this is we're in a range. And leaving aside Powell communication, I think that the last FOMC meeting, what was the most important thing that came out of that was that the Statement of Economic Projections, the SEP, they revised up growth, they revised up inflation expectations, and they kept rates unchanged through 2023 at the median point. So they really tried to send the message, we are not going to get off of negative real yields until this economy is at full employment. And we've got very strong growth. We have some inflation, so we need to add 4 million people back to the labor force. To the working 4 million people back to work, and we need to see some signs of persistent inflation before they're going to move from a negative real yield. So that's going to keep that front end really, nailed down there. To put some limit on make it more of a range trade with quite a lot of volatility though.
Now, thinking about that volatility and the ramifications for investors right now, when you talk with how to use fixed income, when you talk with clients about putting fixed income as part of the portfolio, and lately what we've seen is equity sell-offs, they have to get to like 1% at least down to put any kind of bid into bonds. I mean, we've been watching day to day. Generally speaking, we've been starting off sessions with bonds lower, and when we have a bond sell-off that goes deep enough, it hits the NASDAQ, but then when the NASDAQ keeps going, the bond market doesn't really get a bid until equities really start getting slammed. I mean, what's it going to take here for that type of relationship to normalize, or is it ever going to again, Rob, where bonds are successfully hedging stock routes? Because right now it's not quite doing it.
Well, you're exactly right, Oliver. It's not that effective right now, and I think it comes back to the fact that real yields are negative across the Treasury market. So when real yields are already negative, there's much less room for them to move when you get some sort of growth or financial condition shock. So bonds just are not going to be as effective a shock absorber as they would have been when real yields were much higher. It's just math.
So, Rob, looking at what to think about in terms of kind of a range, the volatility that you mentioned, but this short end of the bond market that's been tied down, thinking about how much more potential the yield curve has to blow out if yields, as we just saw yesterday, made another recovery high. Where should folks think about the range that we could go to for a 10-year? I mean, we came into the year and the average of Bloomberg economists was 1.3%. We broke through that like the first week. Then they moved it up to 1.4, then 1.5, and they just keep moving it up. So where do we think about what's possible and thinking about the regime that we could go to over the next 8 months?
So let's in the near term, we still think this like 175 is probably, we won't break too far through that right now because the short end is so pegged. But we will see the top end of that range drift up over the next year and a half. And if you go back and you think about other times where the Fed has been, we've had a strong economy, the Fed's been sort of really driving. We've gotten concerned that the Fed would tighten policy. You can have yield curve steepness of 2/10s, let's say, out to maybe 250 basis points. That's what we had in the taper tantrum in 2013. And so if we get to an environment where we think that the Fed is going to act relatively soon, so we're really going to stretch that relationship between bonds and the Fed, we could see 250 basis points. But that's not going to be anytime in the next quarter, 2 quarters, because the Fed is really committed to this policy under this AIT framework. Keep rates low, keep negative real yields, and so it limits the amount of upside you can get. And I can tell you, Oliver, this steep curve is one of the steepest curves globally. And I can tell you, as an institutional fixed income manager, there's a lot of interest from non-U.S. investors to buy U.S. bonds and hedge them back into their currency. So there's tremendous amount of demand for fixed income, both in terms of pension fund rebalancing and foreign investor flows that respond to the steepness of the curve. So the steepness of the curve is very important here.
Now, just to make sure I heard you right, 175, thinking about the 10-year yield as having trouble moving through. I mean, that's where we were yesterday. So you guys think we've topped out in terms of how quickly the 10-year yield can move right now?
In the very near term, but 2% maybe in the second quarter as we continue to let that relationship stretch a bit. But we're not looking for a short, a move to 2.5 anytime, or 2.25 anytime in the near future.
Okay.